As mentioned earlier, auditors may communicate the reportable conditions in writing. Be aware of the key elements of this written report, as it is often tested. The report reads as follows. To the Audit Committee. In planning and performing our audit of the financial statements of the Valentine Company for the year ended December 31st, 2000, we considered the internal control in order to determine our auditing procedures for the purpose of expressing our opinion on the financial statements and not to provide assurance on the internal control. However, we noted certain matters involving the internal control and its operations that we consider to be reportable conditions under standards established by the American Institute of Certified Public Accountants. Reportable conditions involve matters coming to our attention relating to significant deficiencies in the design or operation of the internal control that in our judgment could adversely affect the organization's ability to record, process, summarize, and report financial data consistent with the assertions of management in the financial statements. A paragraph is then inserted that describes the reportable conditions that the auditor noted. The final report paragraph says, "This report is intended solely for the information and use of the Audit Committee, Board of Directors, Board of Trustees, or owners in an owner-managed enterprise, management, and others within the organization." End of the report. Please note, the first paragraph states reportable conditions were found in connection with an audit. Quote, "We considered its internal control in order to, expressing our opinion on the financial statements and are not to provide assurance on the internal control." End of quote. The first paragraph references standards established by the American Institute of Certified Public Accountants. The first paragraph defines reportable conditions. The reportable conditions are described in the second paragraph. Finally, the use of the report is restricted. Restricted use to those inside the company as indicated in the last paragraph. Very important. When auditing non-governmental entities, never issue a written report that says, "No reportable conditions have been noted." The last area of this CD covers communications with audit committees. The definition of an audit committee is a group of outsiders appointed by the client's board of directors to oversee the financial accounting and reporting process. Appointees should be outsiders. Applies to all entities subject to the 1933 and 1934 SEC Acts. Applies to banks or other lending institutions that file with the Federal Reserve System. Note, if the entity has less than $10 million in assets and 500 shareholders, they do not have to designate an audit committee, or if they have fewer than 300 stockholders. Recall, an active audit committee is one of the positive control environment factors. The functions of the audit committee are as follows. Oversee the work of the internal auditors. Select the external auditors. Determine the type, scope, and timing of the audit. Discuss reportable conditions, material weaknesses, fraud, illegal acts, the financial statements, and the audit report with the auditor. The method of communication to the audit committee may be verbal or in writing. If communicated verbally, the auditor should document the following in the work papers. 1. The date of communication. 2. The matters communicated. 3. The person or persons who received the communication. 4. The resolution of the matters covered within the communication. If the communication is in writing, the auditor should restrict the distribution of the report to the Audit Committee and Board of Directors and those being informed. Note, the auditor is not required to tell management everything they have communicated to the Audit Committee. Can you recall some of the items that must be communicated to the Audit Committee? Reportable conditions, material weaknesses, illegal acts, fraud, material errors, government compliance issues, and interim financial information, such as the methods used to formulate estimates. Who should communicate to the Audit Committee? The partner in charge of the audit. When should the audit communication take place? No set timing. The communication does not need to take place before completion of the auditor's report. If the matters affect the audit, communicate immediately. Otherwise, the auditor may communicate upon completion of the audit. How often should the same items be re-communicated? Generally, it is not necessary to repeat the communication of recurring matters each year. However, the auditor might want to re-communicate matters when the Audit Committee changes or because of passage of time. Note, this auditing standard does not preclude or restrict the communication of other matters. The auditor may communicate what they feel they need to. This standard, however, establishes the minimum communication. Remember, the auditor is not required to inform management about the items communicated to the Audit Committee. Items the auditor should communicate to the Audit Committee are as follows. The auditor's responsibility under GAS. Remember, auditors only provide reasonable, not absolute assurance. Auditors should communicate the level of responsibility assumed for internal control and for the financial statement misstatements. Significant accounting policies. Inform the Audit Committee about the initial selection of and changes in significant policies made during the year. Areas of concern are revenue recognition, off-balance sheet financing, and accounting for equity investments. Management judgments and accounting estimates. Inform the Audit Committee about the process used to determine estimates, especially sensitive areas such as lawsuits and loss contingencies. Audit adjustments. Communicate audit adjustments whether or not they have been recorded by the client. Clarify that immaterial adjustments in the aggregate could materially affect the financial statements. Inform the committee about the uncorrected misstatements that were aggregated during the year. Auditors' judgments about the quality of the entity's accounting principles. For SEC engagements, the auditor should discuss the auditor's judgment about the quality, not just the acceptability, of the accounting principles used. Involve management and discuss the consistency, clarity, application, and completeness of the policies. Discuss items that may have a significant impact upon the financial statements, such as selection of new or changes to accounting policies, estimates, judgments, and uncertainties, accounting policies relating to significant financial statement items, the timing, and the period in which the transactions were recorded. There is no objective list of items used to evaluate the quality of the accounting policies. Auditors should tailor the discussion to the client, remembering that they are discussing the consistent application of the quality of the accounting principles as applied to the client's financial statements. responsibility for other information in documents containing audited financial statements. Discuss with the Audit Committee the level of responsibility taken for other information prepared by management that accompanies the audited financial statements. The best example is the management discussion and analysis included in the annual report. Auditors should discuss their responsibility, any audit procedures performed upon such information, and the results. Disagreements with management. Usually, this arises over new generally accepted accounting principles, GAAP, estimates, and/or financial statement disclosures. Consultation with other accountants. Auditor discusses with management his or her views about the matters that other accounting firms were consulted upon. Major issues discussed with management prior to retention. Includes discussions regarding the application of accounting principles and auditing standards. Difficulties encountered in performing the audit. Delays, such as the client not completing schedules on time, unavailability of personnel, unreasonable timetables set by management, for example, complete the audit in 1 week. This completes our discussion of communications with audit committees.